Good evening, friends. So, we are going to discuss today uh, some key provisions of the budget 2025. Now, there are several amendments which I think you are already aware of, and I need not dwell upon those amendments which everybody has been talking the talking point, like say a reduction in the rather enhancement in the slab and the new tax regime to 12 lakh and all that. So I will confine my discussion to some of the important provision which I believe require some deliberation to understand the real objective and purpose of these amendments. So to start with the first amendment, which I'm going to discuss is the amendment in the Customs Act, whereby Section 18 capital A has been inserted. Now, this is a very, very significant amendment because till now, you see, in the Customs Act, a bill of entry, which is filed at the time of the customs clearance, is considered as an assessment order. Now, there was a amendment in 2011, and prior to that, the view of the Honorable Supreme Court in the case of Priya Blue Industries was that unless the order for bill of entry, like for each import consignment, a separate bill of entry is to be filed. And each bill of entry is considered as an assessment order in itself. Now, suppose there is an error in filing of the bill of entry. Suppose you have misclassified your item and paid the tax at the higher rate of tax or lower rate of tax. If you have paid at the lower rate of tax, there is no problem. The department will recover the excess duty. But if you have paid the higher rate of tax by inadvertence due to probably maybe misclassification or non-availment of any, say, exemption notification or, say, clerical error, whereby you, say, misdeclare the value of the goods or any such thing, then it is a very difficult task to claim the refund. Because the Honorable Supreme Court in Priya Blue Industries as well as ITC Limited has held that the bill of entry is an assessment order, and therefore, unless that assessment order is challenged by way of an appeal, the refund cannot be granted. So the difficulty which was arising was that in most of the cases, you see, if you have made an inadvertent error, then it is discovered after a lag of some time, maybe on pointing out by the auditor or a senior management or on your own scrutiny. But the time limit for filing of the appeal is only 60 days plus 30 days of the condonation period. So in most of the cases, because of this Supreme Court judgment, any excess payment of tax became a dead case, as there was no possibility of filing an appeal because of the expiry of the period of limitation. And therefore, it was causing a lot of difficulty for the SSCs. Now, you may point out that there is section 149, which allows the uh, revision of the bill of entry, but that revision is subject to the condition imposed by the customs officer, and he may allow, he may not allow. So that is a discretion of the customs officer. And in most of the cases, practically the revision was not being allowed. And on the refusal, the SSCs were taking recourse to the writ court, and it became a long drawn process. So now, in order to obviate all these kind of difficulties, Section 18 capital A has been inserted in the Customs Act, whereby it is allowed you to revise the bill of entry on the self-assessment. And once the revision is done, Then if there is any excess payment of tax, then obviously you can make the payment along with the interest. But if there is a case of refund, then that refund claim can be filed under section 27, and it can be filed within 1 year from the date of the revision in the bill of entry and the payment of the uh, and the revision of the bill of entry. So this will provide much needed relief to the importers and exporters alike, who inadvertently sometimes does commit error in the while either filing the bill of entry or the shipping bill. The second important provision which I would like to point out in the customs is the increase in the customs duty with respect to textile sector, that is knitted fabric. Now the knitted fabric, we are suffering because of the imports from the China particularly, and therefore this increase of customs duty will benefit a lot of manufacturers in Surat as well as in Ludhiana, where all such units producing knitted factory fabric on subtle lace looms are located. Now, in addition to that, the basic customs duty on the subtle lace looms have been exempted, and therefore both these amendments will give a boost to the textile sector, in addition to some other measures like export promotion mission, which will be set up for facilitating easy access to the credit and tackling non-tariff in the overseas market. And also, there is a 5-year mission which will be launched for the cotton growing farmers to improve cotton farming and promote extra long staple varieties. So all these measures are introduced to boost the textile sector, which is one of the biggest employment provider in India, in addition to agriculture. Now, next, I would like to discuss some of the very important provision in the Income Tax Act. I think to start with, uh, the omission of section 206 capital A, B and 206 double C, A is a very important omission, because these provisions provided for deduction of tax at twice the rate applicable in the provisions of the Act if the person from whom the tax is to be deducted is a non-filer of the income tax return. Now, this was creating a lot of difficulties because it is very difficult for the deductor to verify the return status of return filing of the deductee. And therefore, it was creating compliance burden, and the deductors were becoming defaulter for no fault of their own. So the omission of these particular two provisions are very, very important. Then there are several amendments with respect to the increase in the threshold limit for deduction of tax. For example, for professionals like us, it has been increased from 30,000 to 50,000. And for rental, it has been increased from 2,40,000 during the financial year to 50,000 per month. So these are some of the important amendments. Now, another important amendment, I think, which is very important with respect to our cryptocurrency is, I mean, I had a session wherein I discussed in detail about the provisions relating to the direct indirect taxation on the virtual digital assets or crypto assets. Now, in order to plug the loophole of non-deduction of tax at source, or say tracking of the transaction in the crypto assets, a new section has been inserted in 285BAA, whereby any reporting entity, as which may be prescribed, will have to furnish information in respect of transaction in crypto assets within such period and in such form and within such manner as may be prescribed. That prescription is not there, but this is a very important measure to track the transaction with respect to crypto assets. Another very significant amendment which has come is with respect to transfer pricing. Now, the amendment with respect to transfer pricing allows the SEC to opt for a block assessment for 3 years. Now, this is an important change because you see, what is a transfer pricing? Transfer pricing, the purpose is to determine the arm's length price in an international transaction. Now, in most of the cases, the transaction, the quantum of transaction continues with the same associated enterprise over a period of time. The nature of transaction is the same. So if there is a transfer pricing assessment or audit year after year, then it causes compliance burden not only for the SEC but also for the department. So now the option has been given to the SEC that he can opt for the selection of the block of 3 years within which, if any transfer pricing assessment is done, then he can say that it will apply for the next 2 years as well, immediately following the previous year in which such assessment is done. But the difficulty in this particular provision is that while the SEC, who is beneficiary of the transfer pricing assessment or audit, would like to opt for it, but the SEC, who is at the receiving end, may not go for it because there is a likelihood that he may not be selected at all in the next 2 assessment year or financial year. But if he opts for it, then automatically, if any addition is made in the first year, then the such addition will be automatically made in the next 2 financial year as well. So I believe that depending on the benefit to the SEC can choose to go for the block assessment. But at the same time, there may be some SECs who are peace loving and who would not like to go for litigation, and therefore they may opt for this block over period despite any addition on account of transfer price or the arm's length price, which has been determined by the officer. Now, the next important amendment, I think, which is also a very important amendment, is with respect to amendment in the scope of the significant economic presence. Now, section 9 says that, you see, I discussed about the permanent establishment in one of the sessions which I took. Last week I did not do, last week. So I discussed about the importance of permanent establishment, that if one has a permanent establishment in a country, then one is liable to pay tax on profit attributable to permanent establishment, and the rate of tax which is applicable for the business profit will apply. Now, there are several entities who does not require physical presence, but they have a significant economic presence through the digital medium. So in order to tax these kind of entities who have significant economic presence in India without there being a corresponding physical presence, this concept was introduced. But section 9 says that if the activity of a non-resident is restricted to only purchase of the goods in India for the purpose of export outside India, then it is not that the income does not accrue or arise in India. Now, this concept of significant economic presence was creating a doubt whether this only purchase for the purpose of export will also attract this significant economic presence provision of the Act against the SAC. So now it has been clarified that if the transaction is restricted to the purchase of goods in India only for the purpose of export, then this concept of significant economic presence will not make such a business, such transactions equivalent to significant economic presence, and the income attributable to such a transaction will not be taxable in India. Another, let us now go to the discussion of the important provisions of the Goods and Service Tax Act. Now, in the Goods and Service Tax Act, one important provision, that is section 148 capital A, has been proposed to be inserted for implementation of track and trace mechanism for ensuring effective monitoring of specified goods. Now, these goods are prone to evasion of tax like tobacco, pan masala, scrap plastic, and scrap paper. Now, what will happen is that a goods will be notified where this particular provision, whereby the specific unique identification marking will be used for tracking and tracing. Now, this unique identification marking may include a digital stamp, a digital mark, or similar marking, which is unique, secure, and non-removable. So, if any goods which has such a mark can be tracked and traced to find out if there is any evasion of tax which is taking place in the transaction of such goods which are prone to evasion of tax. Now, another important amendment which has come is with respect to section 34 subsection 2, which provides that if the credit note has been issued by a supplier and the buyer has received the input tax credit, then it is necessary that the buyer reverses such an input tax credit for the seller to get deduction from the turnover for reducing his output tax liability. Now, this is a very important amendment and it may be prone to challenge in the courts because it imposes a almost impossible burden on the supplier to ensure that his buyer has reversed the ITC, for which there is no mechanism in the public domain to know whether such a reversal has been done by the buyer or not. So unless there is a mechanism which is developed to ensure the compliance of this law, this particular amendment may be amenable to challenge before the writ court. Another important amendment which has come is in section 107 and 112, wherein earlier only if there is a disputed amount of tax, interest, and penalty, then 10% of the disputed tax at the first appellate stage and another 10% at the tribunal stage was required to be made as a pre-deposit for the purpose of filing of the appeal. Now, this pre-deposit requirement was not there if there was a demand only with respect to penalty, while there was a requirement of deposit of 25% of the penalty amount with respect to a demand under section 129. But suppose if there is a demand under section 122 or any other section where only penalty has been imposed and there is no demand of tax, then there was no requirement of deposit of the, no requirement of making any pre-deposit for filing of the appeal. So now with this amendment, 10% of the disputed amount of penalty, if there is only penalty involved, if there is a tax interest and penalty, then you need to deposit only the amount with respect to the tax. But if there is a demand only of the penalty, then you will have to make 10% of the disputed amount of the penalty at the first stage and 10% at the stage of the tribunal. So for those SSEs where already there is a demand with respect to penalty, it would be advisable to file the appeal without any further delay, because as soon as the bills are passed in both the houses and it receives the presidential assent, it will become part of the act and you will not be able to have the benefit of filing the appeal without making mandatory pre-deposit. So friends, with this, I come to the conclusion of my today's discussion. I just wanted to have a discussion only on the key provisions which I believe required some deliberation. The rest of the provisions, I believe most of you have already updated yourself. So, okay, somebody has a query. So please unmute yourself and ask. You can unmute.
Hello.
Yes, yes, tell me.
Hello. Hello, sir.
Yes.
Am I audible?
Yes, yes.
Yeah, sir. Thank you very much for such a fantastic session, sir. It was quite knowledgeable.
Thank
So,
you.
what
Thank
I
you.
was saying, sir, what I was asking was, like you said, if we have received a credit note and the person has not reversed it from his turnover.
No, I have issued a credit note. Then
Yes.
you see the first question which arises is that I may seek a adjustment in my turnover, because you see, I earlier you see I sold the goods for 100 rupees. Now subsequent to the sale, because of some negotiation, I have given a discount of 10 rupees. So I am entitled to a reduction from my turnover. In the say in the month of April, I sold the goods and paid tax on 100 rupees. Now in the month of say June, I issue a say credit note for say any reason. It may be discount, it may be reduction in the price, or it may be renegotiation. So whether I will be entitled to reduction in my turnover from the month of June because of the issuance of such a credit note. Now the section 34 mandates that unless the recipient, if number one question is whether you are selling it to a business entity. If you are selling it to a consumer who has not received the ITC, then it does not matter. Then you can reduce the price. But if you have sold it to a business entity who is going to further use it for business purpose, then he would have claimed the ITC of the goods sold by you. And if he has claimed the ITC, then he must reverse the ITC before you can claim the benefit of uh, reduction of that credit note from your turnover. That is the point. I hope
So,
I am clear.
sir, my question regarding this is, can we, as an effect of this, do we have to ask our suppliers to issue us a debit note first and upload it on their GST portal, and then we will, take the credit accordingly? Should it happen this way?
No, you see debit note part and section 34, you can have a look whether requirement of debit note is there or not. I am not too sure. You say I will not comment on that because I'm
Mm-hmm.
not too sure about that. Maybe there is such a requirement, maybe there is not. But I'm not too sure about the requirement of the debit note. But what I'm sure about is that the buyer must reverse the ITC in his electronic credit ledger. And for that, whether or not he issues a debit note, you don't be bothered about that. I think what will be important is that you take a certificate from him that he has reversed the ITC and keep it in your books of make it a part of your record
Mm-hmm.
to
And what
avoid
if the buyer,
any.
what if the buyer is a government department?
Whichever may be the department, whether it is a government or private, it does not matter. You will need such a maybe in time to come, the GST and portal will be amended, and there will be some mechanism whereby the buyer will give you some intimation on the portal itself that they've reversed the ITC, and you will come to know about it. Just like GST had 2A mechanism. But as of now, I don't know whether any such mechanism in the portal is there or not. Until the time such a mechanism is developed, it is advisable that you take a certificate from your buyer that he has reversed the ITC.
Thank you, sir. Thank you.
Thank you. Anything else? So shall I close today's session? I don't think there is any further query from anyone. So thank you friends for joining. I am closing today's session. Thanks all. Thank you.